Hello everyone, welcome to the Tim Booker channel. I wish you all an enjoyable listening experience. In this episode, we will delve into a book called King of Capital. It tells the fascinating story of the global private equity giant, the Blackstone Group, and unveils the mysteries of the private equity industry, giving us a deeper understanding of the financial history of Wall Street. First, let's introduce the Blackstone Group. Blackstone is the world's premier private equity investment firm. I'll explain more about the private equity industry later. While Wall Street is home to many long-established investment banks with centuries-old histories, Blackstone, founded in 1985, has grown exponentially in just over 30 years. During this relatively short period, the company has weathered multiple economic downturns and crises, continuously expanding to become the undisputed leader in the private equity industry. That's why Blackstone earned the nickname King of Capital, which is also the title of this book. The title, King of Capital, reflects two main factors. First, it's due to its sheer size. When it was founded, Blackstone had a capital of only $400,000, but today its market value exceeds $20 billion, with assets under management surpassing $400 billion, making it one of the world's largest firms. Second, it's because of its profound influence. Blackstone's business practices have had a profound impact on the industry's development. In just over 30 years, Blackstone has been involved in many notable deals, like the iconic Hilton acquisition, which alone generated a profit of $14 billion, making it the most profitable transaction in private equity history. Understanding Blackstone means understanding the private equity industry as a whole. Private equity is often abbreviated as PE, a term frequently heard in financial circles. Despite sounding mysterious, the workings of this industry are not overly complicated. In essence, private equity firms perform three main functions. 1. Finding projects, identifying suitable target companies to acquire either because they are heavily undervalued or have significant potential for appreciation. 2. Raising funds, designing appropriate financing structures, leveraging financial instruments, and raising the necessary capital for acquisitions. 3. Buying low and selling high, after completing the acquisition, assisting the target company in increasing its value and timing the exit strategy for maximum returns. So, why did Blackstone become the global leader in private equity? It's because they excelled in all three of these aspects, leading to substantial returns for their founders, partners, and investors, as well as a growing influence in the global economy. It's worth noting that Blackstone Group has had significant interactions with China. As early as 2007, China Investment Corporation invested in Blackstone and held the investment for 11 years before divesting in 2018. One of the founders of Blackstone, Steve Schwarzman, made a donation to Tsinghua University, establishing the Schwarzman College with the aim of nurturing future global leaders. In this audio, we will consistently use the name Schwarzman for consistency. The authors of this book, David Carey and John E. Morris, are both accomplished journalists from top American financial magazines with years of experience in reporting on and writing about the private equity industry. Their captivating stories can inspire you through the ups and downs of Blackstone's journey and provide you with a deeper understanding of the private equity industry. Now, let's focus on three key aspects. 1. How did Blackstone seize the major trends on Wall Street, leverage its strengths, and rapidly rise as an entrepreneurial success story? 2. What were the unique strategies and secrets that propelled Blackstone to become the capital king of Wall Street? 3. What role do private equity firms like Blackstone play in the economic system, greedy demons or angels rescuing people from crises? First, let's listen to the story of Blackstone's entrepreneurial beginnings. The founders of Blackstone, Peterson and Schwarzman, both had prior experience working at the renowned Wall Street investment bank, Lehman Brothers. In the early 1980s, Lehman Brothers faced the brink of bankruptcy due to economic downturns and trading mistakes. Although the company eventually recovered from the crisis, it was plagued by internal conflicts, which left Peterson and Schwarzman feeling disenchanted. They decided to break away from Lehman and start their own venture. So, in 1985, with an initial capital of $400,000, they founded Blackstone. While major investment banks typically have extensive product lines, Blackstone chose to focus on one thing: private equity investment. As previously explained, this industry involves raising funds from clients, acquiring equity in target companies, and then selling it at a profit. Because the core operation is mergers and acquisitions, this business is also known as equity M&A. But why did Peterson and Schwarzman decide to enter this field when starting their venture? Firstly, both of them had a genuine interest in this area, having gained considerable experience in the investment industry over the years. Secondly, and more importantly, during that era, equity M&A had become one of the fastest-growing and most prominent businesses on Wall Street. The emergence of this trend was not by chance. In the 1960s, the United States experienced a wave of diversification, with large conglomerates expanding into various industries. However, by the 1970s, many of these conglomerates found that diversification was unsustainable and began selling off assets outside their core industries. This provided numerous opportunities for equity M&A. At the same time, a brokerage firm, Drexel Burnham Lambert, invented financial instruments known as junk bonds. The issuance of junk bonds provided the necessary funds for equity M&A. In the 1980s alone, Drexel issued $80 billion worth of junk bonds, propelling equity M&A into an explosive phase of development. Therefore, the decision of Peterson and Schwarzman to enter this field reflected their keen insight and judgment. However, selecting the right direction did not guarantee smooth sailing for Blackstone, especially considering they started as a small company with initial capital of just $400,000. As mentioned earlier, excelling in equity M&A requires three crucial elements: finding projects, raising funds, and buying low and selling high. Among these, finding projects and raising funds are particularly important. Finding projects means meticulously selecting investment targets in equity M&A. These companies should either be undervalued or have significant growth potential. The goal is to buy low and sell high when the time is right. Raising funds is relatively straightforward. Equity M&A firms don't use their own money, they need to attract investors. Typically, this is done by establishing investment funds to raise capital. In specific project operations, besides using investment capital, various financial leverage tools are often employed to maximize the available funds for acquisitions. In the early days, Blackstone could only assist clients with M&A advisory services, earning a modest $50,000. Nevertheless, Peterson and Schwarzman remained undeterred. They set an ambitious goal of raising a $1 billion investment fund. In the realms of finding projects and raising funds, Peterson and Schwarzman leveraged their strengths effectively. Peterson, being the more senior of the two, had previously served as the Secretary of Commerce in the Nixon administration and was the CEO during his time at Lehman Brothers, where he was Schwarzman's superior. He possessed an extensive network of contacts and influential connections in both politics and business. Schwarzman, on the other hand, was younger and brought his strong analytical skills to the table. He excelled in identifying and evaluating investment targets and knew when to exit for optimal returns. He also had innovative ideas for managing the company. Together, their complementary strengths provided Blackstone with a strong foundation from the very beginning. However, the early stages of Blackstone's journey were not without obstacles. Despite their powerful network of contacts, Blackstone was a new company with no convincing track record. They reached out to hundreds of potential clients, but after several months of effort, all 18 institutions they had high hopes for rejected Blackstone. Ultimately, with the help of Peterson's personal connections, the UK-based Prudential Insurance Company agreed to invest $100 million but imposed strict conditions. Nevertheless, this $100 million was a significant boost for the young Blackstone. Even more importantly, Prudential was a well-established and powerful player, and their investment was essentially an endorsement of Blackstone. Consequently, institutions started approaching Blackstone, including many Japanese organizations, which were looking to invest in the booming U.S. market during Japan's economic bubble. By early 1987, Blackstone had successfully raised $600 million. What did this $600 million mean for Blackstone? First, according to industry norms, Blackstone could earn a 1.5% management fee annually, equivalent to $9 million per year. Additionally, for completed investment projects, Blackstone could earn a 20% share of the profits from the investment returns. For a company that had been in existence for less than 2 years, these revenues were enough to sustain the business. Even more crucially, with $600 million in capital, Peterson and Schwarzman had the means to engage in substantial M&A activities. They soon seized a golden opportunity. In 1988, the U.S. Steel Group decided to divest its struggling transportation business. Blackstone believed that the transportation industry would soon recover, so they invested over $10 million of their own money and secured $600 million in financing from banks to complete the acquisition. The industry indeed began to recover shortly thereafter, and within 2 years, Blackstone had already earned a fourfold return on their investment. By the time they sold all their shares in 2003, Blackstone and its investors had achieved an astonishing 25-fold return, with an average annual return rate of 130%. This deal became an early classic case for Blackstone and established its reputation as a premier investment firm. The preceding narrative outlines Blackstone's early entrepreneurial journey and how they got their start on the right track. Investment and M&A is a high-reward industry, but it also comes with high risks, especially during economic downturns or crises. At such times, investment and M&A firms can be particularly vulnerable. Why is that? For one, it's challenging to secure funding in the market during these periods. Moreover, the companies or assets acquired earlier may face operational difficulties, resulting in a significant drop in value. These challenges can make it nearly impossible to divest, and in some cases, businesses may even go bankrupt. Consequently, many investment and M&A firms with longer histories than Blackstone did not survive. So, how did Blackstone manage to overcome multiple recessions and crises, not only surviving but also thriving to become the capital king? What was their secret? Now, let's move on to the second part, Blackstone's unique formula for becoming the king of Wall Street capital. This book believes that Blackstone's unique formula can be summarized in at least 3 key aspects. Firstly, it's their cautious management style. Secondly, it's their distinctive partnership and subsidiary operation model. And thirdly, it's their robust capability for adding value to acquisitions. Let's start with Blackstone's cautious management style. In the business of mergers and acquisitions, there are often moments that require bold decisions, and sometimes it can even feel a bit like gambling. You have to believe that the equity you're purchasing will substantially appreciate in the future. While Blackstone, as an industry leader, certainly has the courage to make the necessary moves when the time comes, their overall style, especially when compared to more aggressive peers, is noticeably cautious. Let's look at 2 aspects of their cautious approach. First is the prudent allocation of resources. Do you remember that when Blackstone was founded, they started with just $400,000 in initial capital, had only a handful of employees, and rented a very small office space? While the private equity industry primarily relies on raising client funds for investments, starting with $400,000 was quite frugal, even within the industry. Moreover, this money was pooled together by Peterson and Schwarzman, both of whom came from well-off backgrounds and could have easily invested more. They chose this path because they believed that the direction they had chosen should be self-sustaining in the short term without requiring a significant amount of capital. If the $400,000 ran out before the company turned a profit, it would signal that the chosen direction was flawed, and there would be no need to invest more money and take unnecessary risks. In terms of entrepreneurship, this attitude was very cautious and rational. The second aspect is the prudence regarding industry directions. Blackstone doesn't like to follow trends or chase hot sectors. They choose to invest in industries like hospitality, tourism, food, and chemicals, which may not always seem trendy. This is because Blackstone believes that the newest and hottest industries are either uncertain and short-lived or flooded with competing institutions, driving up equity prices to potentially unsustainable levels, essentially overvaluing future returns. Therefore, Blackstone keeps a certain distance from these industries. While this approach may mean missing out on the opportunity for explosive growth, it also helps mitigate the risk of sudden downturns. Blackstone excels in traditional industry investments and often looks for opportunities within the cyclical fluctuations of these industries. Even when dealing with emerging industries, they prefer to approach them from the perspective of combining traditional and emerging sectors. For example, during the late 1990s when the internet was booming, Blackstone didn't directly enter the internet industry. Instead, they chose the cable television network, a traditional sector that could also facilitate internet data transmission. Therefore, the rise of the internet could indirectly benefit this traditional sector. In this industry, Blackstone carefully selected 5 projects and earned over $10 billion in profits. When the internet bubble burst in 2000, Blackstone, having not deeply invested in the internet industry itself, was not heavily affected. This cautious approach has helped Blackstone navigate through numerous recessions and crises successfully. Having discussed their cautious style, let's now delve into the unique aspects of Blackstone's management. In the private equity industry, which heavily relies on top talent, retaining and attracting the best individuals is paramount. The standard practice in the industry is to distribute company shares to top talent, creating a partnership structure where individuals manage the company. However, this approach can lead to the dispersion of company control and can create challenges when dealing with a larger number of talented individuals. Moreover, issues can arise when deciding how to allocate shares among these individuals. It's worth noting that Peterson and Schwarzman left Lehman Brothers to start their own venture precisely because they couldn't bear the infighting within the company. So, what did they do differently? After careful consideration, they designed a completely new partnership model for Blackstone. Rather than distributing shares of Blackstone to the top talent, they created a unique system. When Blackstone wanted to bind a top talent closely to the firm, instead of giving them ownership in Blackstone itself, they established a separate company within the industry that was jointly controlled by the top talent and Blackstone. This way, the top talent's interests were closely tied to Blackstone. In their specific area of responsibility, these top talents effectively became co-owners, working as bosses in their own right. If they performed well, they earned more. This model differed from the standard partnership models seen in law firms, delivery services, and many other industries. In other industries, the partnership model often disperses the parent company's ownership. However, Blackstone's model does not dilute the ownership structure of Blackstone itself. Founders can still maintain a firm grip on the overall direction of the company. This approach has been extremely effective in retaining and attracting top talent to Blackstone, and these jointly controlled, specialized subsidiary companies have become pioneers in expanding Blackstone's business into different sectors. For instance, when Blackstone had a top talent overseeing bond investments, they established a specialized subsidiary called BlackRock. The name BlackRock bears a striking resemblance to Blackstone. BlackRock initially worked closely with Blackstone, but later spun off independently and has since become the world's largest publicly traded investment management firm, managing assets exceeding $6 trillion. Many other specialized companies under Blackstone's umbrella have continued to expand Blackstone's footprint in various industries. This innovative model has not only influenced the private equity industry but has also had an impact on many other sectors. Finally, let's talk about Blackstone's formidable capability to enhance the value of acquired assets. As a private equity firm aiming to become the king of capital, success ultimately hinges on its abilities. It relies on the capacity to earn substantial returns through mergers and acquisitions. So, what does a private equity firm need to succeed? Generally speaking, it requires three key capabilities. 1. The ability to raise funds, which includes attracting client investments, raising investment funds, and utilizing leverage in specific projects to draw additional financial support. 2. The ability to select promising investment targets and complete M&A transactions. 3. The ability to choose the right time and method for cashing in and securing profits. Let's delve into these aspects in more detail. Raising funds relies on connections, brand reputation, adept use of financial tools, and financial leverage. Selecting investment targets involves in-depth research and analysis, as well as forecasting industry trends. Cashing in successfully depends on decisive decision-making and a deep understanding of methods like IPOs. In each of these areas, Blackstone excels and can be considered without weaknesses. However, what truly sets Blackstone apart from its peers is its exceptional ability to add value to the companies it acquires. This capability in enhancing the value of acquired assets is at the core of Blackstone's competitive advantage. So, how does Blackstone achieve this value addition through mergers and acquisitions? There are two main scenarios. Firstly, Blackstone employs countercyclical operations. This means that they understand the cyclical patterns of different industries. When an industry is at a relative low point, Blackstone acquires target companies. Then, when the industry's prospects improve, they capitalize on these investments. Even if the company itself undergoes minimal changes, its value naturally increases with the industry's upturn. Blackstone profits from the difference, thanks to their expertise in identifying and navigating cyclical fluctuations. All private equity firms aspire to execute this strategy, but Blackstone excels at it. The second scenario involves a higher level of technical expertise. After acquiring a target company, Blackstone takes an active role in helping the company reduce costs, enhance management practices, and even expand into new business areas. When Blackstone eventually exits the investment, they can realize more substantial gains due to the combined effect of industry trends and improvements in the target company's operations. Not all firms have the capability to operate in this manner, but Blackstone is exceptionally skilled in this regard. Let's take the example of Blackstone's acquisition of Celanese Corporation, a German publicly traded company specializing in chemical additives. In 2001, during a low point in the chemical industry, Blackstone recognized the investment potential of Celanese and identified opportunities for operational improvements. They initiated negotiations with Celanese management and shareholders while swiftly raising funds in the financial markets. In April 2004, Blackstone completed the acquisition of Celanese for $3.4 billion, marking the largest private equity investment in a publicly traded German company to date. After the acquisition, instead of passively waiting for the chemical industry to recover, Blackstone took proactive measures to improve Celanese operations. They adjusted the management culture, increased flexibility, and eliminated bureaucratic tendencies. Cost-cutting initiatives were implemented, including streamlining production lines in North America, enhancing labor productivity, divesting unprofitable business segments, and relocating some operations to countries with lower labor costs. Furthermore, Blackstone helped Celanese expand its market presence through industry acquisitions. These measures delivered immediate results, with cash flow increasing by over 40% within a year. In 2005, Blackstone assisted Celanese in returning to the U.S. stock market. When Blackstone exited Celanese in 2007, they had accumulated profits of up to $2.9 billion from this M&A transaction. This represented Blackstone's largest single profit to date. The profit derived from this transaction was a result of several factors, including the recovery of the chemical industry, Blackstone's skillful use of financial leverage, and most importantly, the value created by Blackstone's assistance in improving Celanese operations. In conclusion, Blackstone's ability to consistently grow and thrive as a capital king is not merely reliant on market timing or luck. Their success is underpinned by a cautious management style, a unique subsidiary partnership model, and a powerful capability to enhance the value of acquired assets. These three factors constitute the core of Blackstone's successful formula and offer valuable lessons for others in the industry to emulate. Finally, let's discuss a question. What role do private equity firms like Blackstone play in the economic system? Are they angels or devils? Many people, including many in academia and the finance industry, hold negative views of private equity firms. In their eyes, these firms are ruthless, greedy, and heartless. They acquire target companies, strip them of assets, and ruthlessly dismiss executives and employees before selling the companies in the market like livestock, all in pursuit of quick profits. According to this view, private equity firms contribute nothing to the development of the company or the overall economy. This negative perception has persisted for some time, and it's reflected in popular works like Barbarians at the Gate, a business classic about Wall Street corporate raiders competing for the acquisition of Nabisco, the company behind Oreo cookies. The use of the term barbarians in the title illustrates the author's attitude toward mergers and acquisitions. However, this book takes a different stance. It suggests that although private equity firms sometimes need to make adjustments to the business and workforce of target companies, which may seem cold-hearted, their ultimate goal is to make these companies more valuable in the market. This, in turn, allows them to fetch a better price when selling the company. If another buyer is willing to pay more for the company, it indicates that the prior adjustments, seemingly ruthless, were indeed beneficial to the company. Helping undervalued companies gain more recognition in the market is a way for private equity firms to create value within the economic system. As long as they adhere to legal regulations, there is no need for moral condemnation. Organizations like Blackstone have a track record of pursuing friendly acquisitions. Friendly acquisitions involve extensive pre-acquisition communication with employees, shareholders, and management teams to consider their interests and concerns. After the acquisition, private equity firms typically retain most of the management team and apply their expertise to help the target company improve its operations and achieve value growth. They may even inject their own industry and financial resources into the target company. The case of Celanese Corporation mentioned earlier is a prime example of a friendly acquisition that resulted in value enhancement. In this acquisition, Celanese profitability significantly increased, and Blackstone earned substantial profits. Both the previous and new shareholders of Celanese willingly participated in the transaction, creating a win-win situation. This, in essence, is a positive contribution to the overall economic development. While it's true that in the early stages of private equity investment, there were more instances of quick in-and-out deals and hostile takeovers with brutal layoffs, Blackstone set a principle early on to avoid hostile takeovers and pioneered the trend of friendly acquisitions within the industry. In the model of friendly acquisitions, private equity firms focus on friendly negotiations with the target company's original shareholders and management teams. After the acquisition, they generally retain most of the management team and apply their expertise to help the target company improve its operations and achieve value growth. Therefore, this book argues that because players like Blackstone tend to favor friendly acquisitions and have the ability to help target companies achieve value growth, the private equity industry is not inherently malevolent. Instead, it plays a valuable and contributory role in the development of both individual companies and the broader economy. While there have been cases where positions were eliminated during cost-cutting and business adjustments, this was often accompanied by the creation of new positions. The net reduction in jobs typically represented a small fraction of the total workforce, around 4%, while labor productivity increased by nearly 50%. Company performance and market valuations improved significantly, demonstrating the value of these adjustments. In the history of private equity investment, early stages did see more instances of quick in-and-out deals and hostile takeovers, with wholesale layoffs of management. However, Blackstone, from its inception, set out to avoid hostile takeovers and championed the model of friendly acquisitions. In friendly acquisitions, private equity firms prioritize cooperative negotiations with the target company's original shareholders and management teams. After the acquisition, they typically retain most of the management team and leverage their expertise to help the target company enhance its operations and realize value growth. In conclusion, this book contends that private equity firms like Blackstone, which tend to engage in friendly acquisitions and have the capability to help target companies grow in value, are not malevolent. Instead, they play a positive and proactive role in both corporate development and overall economic progress. Although the private equity industry faced challenges, including the financial crisis, in the long run, it has substantial room for growth. With that, we've covered the key insights of this book. Congratulations on completing another book, and thank you for your support and attention. Please subscribe to the Tim Booker channel, like, and share this valuable knowledge with your friends. Let's combine wisdom with practical action to achieve our financial goals and create a brighter future. Thank you all, and goodbye.